Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the ATR Breakout strategy, a powerful approach that uses market volatility to identify high probability trading opportunities. Now, this strategy is going to help you determine when price is truly breaking out of its normal range, allowing you to capture significant market moves while managing your risks effectively. So stay tuned until the end of this video to discover how you can implement this strategy, a step-by-step process, and you can learn the common mistakes that traders need to avoid for maximizing its potential. We start by understanding what the ATR breakout strategy is, and it is the average true range breakout strategy. This uses the market volatility to identify specified price movements beyond normal trading range. The ATR indicator measures volatility by calculating the average range of price movements over a specific period, typically 14 period. So when you are using your indicator, you would know how to set it to a period length of 14. This strategy creates a channel around price using the ATR value, establishing dynamic support and resistance levels to identify or to adapt to the changes in the market condition. Remember, when price breaks above the upper channel boundary, it signifies a potential opportunity to the upside. That's a bullish opportunity. When price breaks below the lower boundaries, this indicates a possible bearish opportunity. This breakout represents movement beyond the asset's normal volatility range, filtering out insignificant price fluctuation. The ATR breakout strategy offers two key advantages. It adapts automatically to market conditions, and it provides a framework for risk management. During a volatile period, the channel widens, meaning your indicator widens during a during a volatile period. Now, during a quiet period, it means that the indicator would squeeze, meaning there are no volatility in the market. This indicator also help us to set stop loss and take profit at arbitrary price levels. So let's look at how we can implement the ATR breakout system to our chart. The first step is always to set up your chart, and to set up your chart, all you need to do is to add your ATR indicator, your average true range indicator, to your chart, and you make sure it is set at a 14 period length. This should be your standard settings for your ATR indicator. This is your baseline. Now you have to create the ATR channel by plotting lines where the upper boundary and the middle boundary on your ATR, meaning this area you see your ATR, you set boundaries on your ATR indicator. At this area in price, you can just set your boundaries at your ATR indicator upper boundary and your lower boundary. This is all you need to do, and you can see it coincides with the ranging market on the chart. The second step is to identify the breakout. You look for price action that approaches this channel boundary, and as you can see, price action is approaching this upper boundary area. This represents a potential breakout zone where price might move beyond its normal volatility range. And as you can see, when price broke out from the upper boundary, you can see on the indicator it broke out from our upper boundary on the indicator, signifying a bullish trade. Now, for a bullish trade, the step 3 is to execute your trade. For the bullish trade, you wait for price to close above the upper ATR channel. So when price have closed above the upper ATR channel, and as you can see at this area, price have closed above the ATR channel, you enter the market on the open of the next candle. So the moment price has closed above this ATR channel, you would enter at the open of the next candle. This is where you would enter your trade. While in a bearish trade, in a bearish scenario, you wait for price to close below the lower ATR channel. Let's say in this area, price in this area, let's look for a bearish scenario. Look for a bearish scenario to see what we can explain better what we are talking about. You can see in this area in the market, when price consolidated, moved between the upper boundaries and the lower boundaries. If you look at your ATR level, you can see at that same area price moved in a sideways direction. The moment price broke out from the lower boundary, the ATR broke out from its lower boundary, signifying we are moving to the downside. Remember, a breakout from the lower boundary indicates bearish move to the downside. So you confirm your breakout with at least one strong candle to the downside, and you will enter at the open of the next candle. So after this candle to the downside, you can enter at the next candle in this area. This is where you would want to enter after your breakout candle, the open of the next candle. Now the fourth step is to set your stop loss, to set your protective stop loss. Now for a long position, how do you set your stop loss? You calculate your stop loss by your entry value. Your entry value, which is in this trade your AUD dollar pair, AUD USD dollar pair, you would enter at 0.6137. This is your entry point. All you need to do is multiply the ATR value times 1.5 and subtract it from this your entry value, meaning this ATR value at your entry point. This is what we mean. Now let me make it a bit understandable for you. This value, this point where we entered at 61352. We entered at 0.6125 correctly. We entered at 61370. 61370. This is where we entered, and at that point where we entered, our ATR value is 0.0249. 0.0249. That is the area we entered. Now this is the calculation. Your entry will be subtracted from 1.5 times your ATR value at your entry point, and this is what it gave us, 0.6104, and this is where you will place your stop loss in a buying trade, 0.16104. That is where you would place your stop loss. And this is how to calculate stop loss using your ATR indicator. While in a short position, all you need to do is you would add. Instead of subtraction, all you need to do is to add. At this area, your entry point plus your ATR value times 1.5. Whatever it gives you, you add it and you set your stop loss. Now, You can also use your ATR value, your ATR indicator, to set your position size or to calculate your position size. This ATR indicator is a very versatile tool, and we should know how to capitalize on it. Now, to calculate your position size, you'd have to use the ATR formula. You use the position size will be equal to your account risk, whatever you are risking. Let's say in your account you are trading a $5,000 account. What you are willing to risk will be $50. Let's say 1% of your account is $50. So $50 divided by your ATR base stop distance. That is the formula. So this will ensure you are using a consistent risk across different market conditions. Now the step 6 is to establish profit target. Now when it gets to establishing profit target, we would use a formula to calculate the profit target. The formula is you would add your risks, whatever you are willing to risk, you multiply your risk times 1.5. That will be your first profit target, meaning whatever calculation you have gotten as your risk, you multiply it times your 1.5. Whatever you get there times 1.5 will give us your first profit target. Your second profit target will be 2 times your risk, and the third profit target can be 3 times what you are willing your risk area. This is how to calculate using the ATR for your take profit and stop losses. You can also decide, if you know the calculation is too much for you, you can also decide to just take using a standard risk to reward of 1:2 or 1:3, as the case may be. You can also decide to put your stops just below your resistance region to be on a safer side. Then you can also decide to take partial profits while the trade moves in your favor. You can also decide to use a trading stop loss. These are ways you can manage your trade without using the ATR. But in this strategy, we are talking about using the ATR. So the step 7 is to always try as much as possible to implement trading stop loss. It will also help you to capitalize on the market when they move in your position. Excuse me. The step 8 will be to adjust for market condition. You have to modify your approach based on the market behavior. You can use a lower ATR, which is a lower average true range multiplier in trending markets, and a higher multiplier in ranging markets. That means the standard 14 period that we use in this ATR indicator works best on major pairs. Why? If you want to make use of other instruments, like a more volatile instrument such as your crypto and your index, you can make use of 20 period length. You set it to 20, and this would help you to adjust to the volatility of that pair. And the step 9 will be to filter trades with trend direction. You have to enhance your success rate by aligning with the larger trend. You can only take long breakouts when price is above the 200 period moving average, and short breakouts when price is below it. Meaning you just need to include your moving average to help you filter out the trades you are willing to take. Your simple moving average, you would adjust it to 200 period moving average. This is all you need to do, adjusting it to 200. Then it will help you to filter out some trades you take. You can only look for buying scenarios when price is above this your 200 moving average line. Then you look for only selling trade when price is below the 200 period moving average. This is another indication, and it is another confidence you can add so that you wouldn't take any trade anywhere you see the trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next